1st of June 2021. AMC has been on the news lately, so you decide to open an options position on it. Trading at $30, your prediction is that at some point over the next 45 days, AMC will be trading at around $60 per share. You decide to initiate a call ratio spread with 45 days to expiration and a position consisting of one long $35 call and two short $60 calls. This position has a maximum profit at a stock price of $60, which is where you're predicting the stock will be at some point during the next 45 days. On your broker's trading page, you select the calls with 45 days to expiration and buy one of the 35 calls while simultaneously selling two of the $60 calls. Your order is filled for a credit of $197, so if you analyze your current position, your max profit is $2,697 if AMC expires exactly at $60. But your position will at least be profitable at every price below your break-even of $86.97. On the next day, your prediction comes true and AMC is trading at around $60. You realize that since it's not expiration yet, you might not make your full max profit, but you'd be happy with at least 50% of that. When you look at your monitor page, with AMC now trading at $60, you realize that not only do you not have a large profit, but you actually have a loss of around $2,000. How can this be if AMC is right at the stock price with a max profit for your call ratio spread? Stick around to find out. When you look at your broker's options trading page, you can see the underlying price, and the days to expiration for the options that you're currently analyzing. Based on the underlying price, we can easily identify calls and puts that are in the money and out of the money. We already know that the price of an option is made up of two components, intrinsic and extrinsic values. On our trading page, we can see the option price and have set it up so that we can look at the intrinsic value and extrinsic value for every option. If we look at both intrinsic and extrinsic values for calls and puts, we can see that only in-the-money options have intrinsic value, whereas all current options have extrinsic value. The options that are currently up on the screen have 49 days to expiration. So if you focus on the intrinsic and extrinsic values for calls, as we take a look at options with fewer days to expiration, you're going to notice how they change as the days to expiration change. We can see now 33 days to expiration with the same intrinsic value as the ones for 49 days to expiration, but with a lower extrinsic value because of less time to expiration. Same with 26, 17, 10, 4, and 0 days to expiration. We can see here that if we isolate intrinsic and extrinsic values for calls and puts with different days to expiration, it is clear that intrinsic value does not change based on time remaining before expiration, whereas extrinsic value does. If we have a graphical representation of intrinsic and extrinsic values, in this case for a call, you will see that intrinsic value exists only for in-the-money options, and extrinsic value exists for all options. Also, with less time to expiration, intrinsic value remains the same, but extrinsic value goes down for options with any strike. Notice how extrinsic value peaks right at the money, tapering off as you start getting away from the current stock price. Now that we know what they are, how can we interpret intrinsic and extrinsic values? What do they represent? Going back to a stock price chart, we can see its current stock price, and if we want to know the intrinsic value for its options, it will only depend on the option's strike prices compared to the current stock price. Calls where the stock price is higher than their strike price will have an intrinsic value equal to the difference between the current stock price minus their strike price. In the case of puts, it's the other way around. Only puts with strike prices higher than the current stock price will have an intrinsic value that will be equal to their strike price minus the current stock price. Notice how at the money and out of the money options have no intrinsic value, only options that are in the money. If we try to predict a range of potential stock prices in the future, we could use a probability cone, essentially a graphical representation of statistically likely future stock prices based on time remaining and how volatile the stock is. From what we've seen so far, we can conclude that intrinsic value is a measure of real tangible value in our options, whereas extrinsic value is the market's current estimation of potential gains because of changes in stock prices between now and expiration due to a stock's volatility or potential for price change. Based on this, we can see that extrinsic value depends on where the option strike price is with respect to the current stock price, and it also depends on the remaining time to expiration. Since we saw previously that as time to expiration was less, extrinsic value was lower. In addition to this, it also depends on the potential for that stock price to change during the life of the option, measured with a value called implied volatility. Essentially, an option will be worth more in potential gains measured with extrinsic value if an option has more time to reach higher or lower prices, and also if that option has more volatility, thereby enabling that stock price to reach prices that are further and further away from the current price. Conceptually, we could conclude that the greater the time to expiration, the greater the extrinsic value, and vice versa. Likewise, a higher value of implied volatility will lead to a higher extrinsic value and vice versa as well. Implied volatility and time to expiration are related when it comes to options, and especially extrinsic value. You need time to expiration in your options so that the stock price can change in the meantime, potentially leading to profits, but you also need volatility, which is a representation of the level of variability of a stock price over time. This is the reason why in most options formulas, you'll find these terms together, sigma and the square root of time, implied volatility and the square root of the time remaining before expiration. In a very real way, a higher level of implied volatility is something similar to thinking about having a longer time to expiration, and a lower level of implied volatility has the same net effect of having less time to expiration. You're probably familiar with a graph similar to this one, sometimes called a payoff diagram, a risk profile graph, or a P&L graph. It represents the option strategy's profit or loss up or down on the y-axis as the stock price changes on the x-axis, from left to right. On the graph, we can see both an expiration and a current line, both showing potential profits and losses. The important thing to understand here is that most traders only look at the expiration profit and loss line, which is shown here with a solid line, when in reality, a much more important line to focus on is the current profit and loss line, included here as a broken line. It is this line that represents current profits and losses as the stock price changes right now, and over time, this line itself changes shape, shifts up or down, and in general, adjusts to changes in time to expiration and implied volatility. The difference between the expiration line and the current P&L line is the amount of extrinsic value remaining in the position. At expiration, the current P&L line will merge with the expiration P&L line since extrinsic value will go down to zero and only intrinsic value will remain. It is important that you pay much more attention to the current P&L line on your positions since those will represent your profits and losses today as the stock price changes, not the expiration P&L line. Now, we'll see some option strategies that you're already familiar with. Pay special attention to the difference between the current P&L line and the P&L line at expiration. We already saw the payoff diagram for a long call. Now let's look at a long call spread, a call ratio spread, and a short strangle. Again, notice the difference between the broken current P&L line and the solid expiration P&L line. If we take, for example, the short strangle and we analyze a real position in the market, it'll have a blue P&L line at expiration and a purple line representing the current P&L for this position. Notice how if the stock price goes higher, the position will have the P&L predicted by the current P&L line and not the expiration line. Same if the stock price goes lower. So to summarize, you should not focus on the familiar expiration P&L lines for your positions, but rather your focus should always be on your current P&L line. Also, as we mentioned before, this current P&L line changes as time to expiration and implied volatility change. Time to expiration can only go down, but implied volatility could go up or down, depending on market conditions. In this case, if time to expiration or implied volatility or both go down, the current P&L line will be shifted upwards because a short strangle is a short premium strategy, where premium is another word for extrinsic value in an option. In terms of Greeks, the profits or losses due to the passage of time are quantified by theta, and the ones related to implied volatility are quantified by vega. On the other hand, if implied volatility goes higher, the current P&L line will be affected in the opposite direction as before, so it'll be shifted down. In this short premium strategy, an increase in implied volatility is so harmful to our position that at this point, there is no stock price at all where we could possibly have any profits, and this is a direct result of the increase in implied volatility. Having seen all this, we can ask ourselves, why is this important? Let's illustrate this with an example, similar to the one we had at the beginning of the lesson. Let's analyze a call ratio spread with an expiration that is 47 days away. For this exercise, we'll assume that implied volatility will remain constant throughout. If our current stock price goes to our short call strike right away, we'll have losses, even though this is exactly the price at which you would have max profit at expiration. This is because there is plenty of extrinsic value still to come out of the position. It is only when all or most of the remaining extrinsic value is taken out of the position that you will see significant profits at that stock price. Now, 21 days later, with 26 days still remaining before expiration, if the stock price is at the same strike price we analyzed before, we would have no profit or loss. And if that happens 42 days after putting it on, that is, with only 5 days before expiration, we would have 50% of the max profit calculated when we initially put this position on. Notice how the stock price was exactly the same in all three instances, but at different points in time, which significantly changed the shape of the current P&L line, to the point where the same stock price produced losses in one instance, no P&L in another, and significant profits in the third, depending on at which point in the option's life cycle it reached that price. Now, we'll analyze several option strategies and how their current P&L line changes over time. On the lower right-hand corner, we're going to show the strategy that is being analyzed. This dotted line represents the current stock price, and the blue line represents the P&L line at expiration, with the purple line representing the current P&L line, initially with 46 days to expiration. On the upper left-hand corner, we're going to have a fixed expiration date for this strategy, and below it, the current date, which is what we're going to change to simulate the passage of time. You will have an opportunity to get a feel for how the current P&L line changes over time, so that you can predict your profits and losses more accurately. Just keep in mind that we're only simulating the passage of time, which would be the same as simulating a decrease in implied volatility. The current P&L line would change in the opposite direction for an increase in implied volatility, helping long premium strategies and hurting short premium ones.